What's up, YouTube? Any interest in making a loan on a piece of vacant property in Pigeon Forge, Tennessee? That's sort of the question I'm asking myself, although this is not actually a loan. Oh, by the way, hey, it's Joe Catchpalia making some money investing in fractional real estate online, as usual. Oh, I think I left out the sitting on the couch part. But that's what I'm always doing, just trying to get that couch money. This is a new listing on lofty.ai. I'm trying to figure out, does this one make any sense? This is, they've compared this style of deal quite often to like a home equity loan or a home equity line of credit. Um, I think for a couple reasons that comparison falls down, but it's, I understand why they say that. So what are they doing here? This person owns a piece of vacant land. He needs some cash for another project he's doing. It looks like, and I want to show you that other project because it's all these townhomes. I don't remember how many there are. I think it was 12 that he's trying to finish up. These are the renderings. He actually provided some pictures of what they look like, what it looks like today, and they've got a ways to go still. But he's running low on cash by his own admission and needs to pull some money out of something, and he's chosen this lot in the same market. It's a lot. Let me see that. I think he has plans and permits to build, yeah, a 4-unit townhome style building. So very similar to that one we just looked at, but just 4 units. Um, but this is one of the deals where he's, selling tokens on Lofty. If you buy those, he's guaranteeing a 10% rental yield. So basically, and for over 3 years, and then we'll buy the tokens back for $53 at the end of 3 years, and has the right to buy them back earlier for $53 at any time. And so they're saying, okay, that's a 10% projected yield and 12% 12% projected annual return. Had another long day today. Spent the whole day at SeaWorld. I don't know that I've mentioned this very much on this channel, but I am quasi disabled, which is a big part of why I very rarely get off the couch. You can imagine a trip to a giant amusement park is very close to torture for me. So I'm going to try to hold it together though to get this video done. Um, so let's see. Uh, So I did a little bit of math, right? So, okay, we spend $52.75 per token. And you said, oh, but it's $50. Yeah, but if I click on buy, it's $52.75 per token, right? Because we have the Lofty fee and then we have the OR, right? The operating reserve contribution. And those are limit orders. Each year, so year one, we make $5. Year two, we make $5. Year three, we make $5 plus the $53. And then in this scenario, I said, okay, plus we're getting back the $1.25 that we had contributed to the operating reserve when we first bought it. This seems like this is how a lot of these are operating, right? I mean, they have that operating reserve there, but nothing ever happens with it. And so if you look at the IRR on that, this is a 10.33% return, right? Nowhere close to 12. Um, you know, they're just doing really basic math when they do that 12. They're saying $3 is a 6% return. We're dividing that by the 3 years. That's 2% each year. So I mean, it makes very little sense to even look at that number. Um, if you ignore the OR altogether, or you say, okay, what if we just, as soon as it's sold out, we just do a vote and pay back the OR to everybody, the operating reserve? Well, okay, so now we just spent 51.50 if you did it, if you paid that back immediately, but then you get $5 the next year, $5 the next year, $5 plus 350 or plus $53 the final year. So again, I mean, you're at 10.58% IRR. So that's your return, right? You're not getting 12%. So, um, and this is just math, right? There's not a whole lot that you can argue about with this. They just ignore their fees when they calculate it, and they're doing just a really guerrilla math type of saying, oh, where you're getting 2% appreciation each year, but ignoring that it's not compounding, right? Um, so there's that. So of course, if it was paid off earlier for some reason, you could get a little bit higher return. But in general, I'd expect somewhere right around that 10 point 58%. Does that sound like a good deal for a loan? Well, okay, first let's look at the collateral a little bit because that's always important, right? And that's what I'm going to kind of do is look at this as if we are making a loan on this, even though again it's not really a loan, but because it's a guaranteed yield, a specific yield, and because he has the right to pay it back and he's required to pay it back to buy them back, it makes it operate very similarly to a loan, right? Um, but so, okay, let's take a look at the collateral, right? I'm looking in the market. It's Pigeon Forge. I know this is a really hot vacation rental market. Especially during COVID, everybody on the internet was talking about this. This is one of the markets where they were buying in. I wish that this was updated to show the population since 2020. My guess is it's continued to grow. One of the things that I did is look at what do we do here? The submarket overview on AirDNA for this, right? Because this is really, let's see, can we go back there? Oh, okay, I screwed that up. Let's click on this. This market, when I was looking at the market itself, it's a very small market, right? This is really it's all driven by Airbnbs and short-term rentals. You can see there's 3.8 thousand short-term rentals listings in the market, and what was we have a total population of 6,343. So obviously vacation rentals are a huge part of the business there, or a huge part of the local economy. um I was looking at this. Why does it keep bringing me back to this? I want to get to here we go, submarket performance. So it's not a great occupancy rate, like 59%. I think this has to do, it's actually not as seasonal, there's not as much seasonality as I would have expected, although you have some. Your revenue per available room, though, is very seasonal. But so one of the things I was looking at was, okay, what does that growth rate look like over the last? It'll only go back 3 years for me, but it's going. It looks pretty strong, right? It looks like this is a market that's continuing to do well. I know, like Joshua Tree and some of the other, like I think of them as meme markets or like YouTube markets, like everybody was talking about them. Um, I think a lot of those, have fallen down, but it looks like that's not the case here at the moment, right? So I don't know. I spent some time looking into this market. Um, this was one of the things that, what percentage of the you can do this? Yeah, let's do this for 3 years, right? To see how this has changed. And so, okay, we're pretty similar in. This is our occupancy number. You know, Looking at it, we haven't had a big drop off in occupancy. Um, I did the same thing for how, length of stay. You can see we have a little bit of drop there, but it's not huge. But the length of stay makes a big difference on your profitability. So it has gone down a little bit. Um, let's see, how much revenue did each listing earn per month? Right. Let's look at that. Okay, we're pretty much exactly in line with 2023, a little bit below 2024. Um, how much revenue did listings earn per bedroom, right? Let's see how that changed. Um, let's see. Oh, so that's really interesting. Oh, no, 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 that's just the one. Okay. This is just going further back. So they did this one different, right? They stretched it out. Um, but so I looked at a whole bunch of this. It looks like the market is actually uh, you know, doing relatively well. Okay, average daily rate looks like we're actually doing pretty well there. And why do I care about that? Well, we have vacant land, and the only way you get paid back on a land loan is if whenever is if there's it's if there's a sale, right, and somebody only buys this if they think they can do something with it, or if they're holding it for investment, or if somebody's going to build on it, you get taken out with like a construction loan. And so I want to see, okay, what does this market look like? Does it, how likely is it that somebody's going to build a short-term rental there? Obviously, this guy is building and selling similar units, so at least at the moment, presumably he believes there's a demand. He's putting more money into it. I was looking, there is a decent amount of land for sale in that area, in Pigeon Forge in general. Mostly for the value, I was relying on the appraisal because it's really hard to figure out the comps. But I want to, but so anyway, basically the reason I look into the market is to figure out like, is there, if it was declining, for example, I'd be very worried about buying land because when a market, when there is a downturn, land becomes the hardest thing to sell because nobody buys land if they don't think they're going to build and sell, right? I mean, that's the there are people that land bank and are hold it, but the main buyer and the marginal buyer who's going to pay the most is going to be somebody who's expecting to build on it relatively soon. Um, so that gives me a sense of like what do I think, and so it looks pretty good right now. But I know there's a lot of people concerned about the economy in general, and short-term rentals specifically struggle, when the economy is not doing well. Um, so I think there's a lot of risk in this deal, right? I think there's a lot of risk from the perspective of does that, even though the market is still holding up, is that going to continue over the next 3 years? Is there, because when they're, I mean, land values, I don't know. I actually bought and sold a lot of land for myself. I've been involved in lots of land deals, and it's one of those things where in the wrong time, people end up like, and the reason I've done it is because you can buy land super cheap when the market starts to soften, right? Because people just they're not going to build on it anytime soon. If they need to get cash out, they end up selling it super cheap, right? I mean that's something that's happens quite a bit, and so because of that, you typically see um, lenders not really not really wanting to lend on land. When they do, they're typically relatively low LTVs, often as sometimes as low as 50%, but like 65%, maybe a little bit better. um, they tend to be very high rates, and so just want to keep that in mind as we're thinking about, okay, does this look like a loan that I would want to make, right? Like, okay, so I'm going to get a little bit over 10%. um, it did look like, from, just for the little bit of work I did on the market, it seemed like, yeah, I can, I'm not terrified, right? Like, I don't think this is just like, okay, let me just take cash out of this because I'm going to dump it. It looks like that there's, especially if you're in this market, there's probably, if you're bullish on it, there's reason to believe that once you sell out of your other project, you're going to go and sell, this one is the next thing, and it makes a lot of sense. One of the things that you always want to try to figure out is, is that what's going on, or am I making a loan that somebody just plans on, using as a way to take cash out, but really just dump the property on us as the lender, which happens, more often than you might think. Um, we got so if you're thinking about if it is a loan, usually you want to think about your, the borrower, right, and their ability to repay. In this instance, we find out he's got a good credit score, right? 729. We know he's developing something else that he's running low on cash on, but so we don't really get any information. They just, they said, okay, he passed a criminal background check and we have a credit score. Well, if we're comparing this to a loan, which like Lofty themselves have called this kind of like a HELOC style listing, we should get some information about the borrower. Yeah, see, I'm really tripping over words. Sorry about that today. But we should get some info about the borrower to figure out how likely are they to be able to pay that, right? I think anytime we're relying on the co-owner that's bringing the property to the site to pay us a credit or to pay us rent or any of that, um, we really should be asking for some indications of, can they continue to make this payment. So if I were going to invest in this one, I'd spend a little bit more time digging into this guy, John Dustin Cole. From what I've seen so far, I don't have any reason to believe that he wouldn't be able to pay it back, but we also, that's not the way we do it, right? We want to get some evidence that they can, right? So I'd like to know a little bit about his income, his other debts, that sort of thing. especially because he's also, he's responsible for paying any maintenance costs of the property, for paying the property taxes, for paying the insurance. So all of those things, if that we're relying on the co-owner to pay, um, I want to know that they can do it, right? Because that's the only place where this yield is coming from. Otherwise, if we took back the property and we own a piece of vacant land, we're not getting any yield on that property, right? Um, and so, that's one of the things, right? You want to think about the borrower, but then we also want to think about the collateral. That's what I jumped into first, but I meant to tell you about this, so sorry about that. But so a little bit more about the collateral. What are they bringing it to the market for, right? They're saying, okay, 105,000 is the underlying asset price. Well, this is the inflated asset price, right? Let's see. Well, he bought it for 85,000, but it is the appraisal said, that was around a year ago. Do I have that? I think I have that up somewhere. Um, that shows the amount, but yeah, less than a year ago, actually. 85,000. But the appraisal says, okay, it's worth 100. One of the things in here, I'm sorry, I know I'm jumping around a bunch. This is how my brain works. They describe this as a flat and cleared lot. Um, I'd like to have a picture of it cleared, right? Like, I mean, I'm just looking on Google Maps. It's not cleared here, or the street view. None of the pictures that we were given here show a cleared lot. So it would be nice, if the description in the detail says it's cleared and flat, it would be nice to be able to verify that. So, okay, it doesn't look cleared in here, but maybe that's been done. But then they also call it flat, and I think this must just be relative because this is not, okay, this is the lot behind it, but like this is not what I would call a flat lot, right? But this might just be because I live in San Antonio, Texas, and we have like perfectly flat lots for most of our lots. But so I wanted to share, I don't know if I've ever used this before, but you can use this terrain map and look at the topography here on Google Maps. Um, and so it is right in here. And so there is like this ridge, like this does not look like flat to me. Now, and like I said, I think that might be relative though. When I was looking at the renderings for that the other one that he built, it looks like that's really on a slope. So, if you're building in the mountains, maybe you have a different criteria for what flat means. And so I can kind of live with that. But I'd love to see a picture of this being actually being cleared. I've built on a lot that had a lot of trees on it before. It's not cheap to get trees cut down and removed. And, and I don't know that it's really enough that you get somebody to actually pay you for these or any of this is actually real lumber because it's looks like mostly all little trees. So I think you're actually just paying to get that done. And it can be pricey, depending on. So, not that that's something that we have to pay, but if if part of the value of this is that it's cleared and flat, I'd like it to be. And maybe this is actually just, I don't know, maybe I'm in a bad angle at this. Let me go back out and, uh-oh, where do we go here? Um, I lost it. Let's look at this. Look for this again. Oh, come on. Why is it not putting the little? Okay, there's Connor Drive. Connor Drive, Connor Heights. It's right here. So I was actually just looking from this side. And let's see. Is that it or is this it? Which way am I facing here? Yeah, I think this is it. Maybe I was really just looking at it the wrong way. So yeah, this is one neighboring property. I mean, that ridge is definitely there. Like that, wouldn't call that flat, but maybe, I mean, this seems like, I think this is the neighbor's yard. I don't know. But I would just like some pictures that are not the pictures from when they bought it. Because when I looked at this, that's what this looks like, right? These pictures look just like the listing pictures from when they bought it. If they've done anything to this lot, it would be good to know. Um, yeah, I think they just stole some of the pictures from this lot, from that listing to put this up here. I don't know. Maybe they changed it a little bit. Did they? I guess maybe they did. Maybe they added. Nope, that's this picture right here. So yeah, I don't know. Because what I want to know is, did they buy it for 85 and now they're selling it to us for 105 less than a year later? And it's the same exact lot. They didn't clear it. They didn't, maybe they're the ones that went and got, renderings done in the permits. They did say that those rendering or that the architectural plans would convey, I think. Yeah. Um, but again, I mean, it doesn't really add to the value of the collateral. It might make it appealing if that's exactly what the next person wants to build. I have tried to sell land with plans before. I mean, sometimes it can be good, but sometimes, depending on, especially if you decide against building it, well, then that's problematic, right? So let me see. Okay, you've got the oh, we've got the lease agreement. My computer is really mad at me because I have too many tabs open. I'm going to wait a second and then I'm going to pause it if that doesn't work. Sorry about that. I don't know why everything's just going so slow. But so, this is the lease agreement. It's a really simple lease. This is kind of what we've seen with the other ones where the co-owner is leasing it back to us. Um, it is kind of interesting, the period of this is for 5 years, where he's got to buy it back sooner. Maybe that's just so it's clear that if he for some reason doesn't buy it back, um, we have the ability to continue to collect rent. Basically just says everything is his responsibility. Maintenance and repairs. Okay, well, it's land. Utilities, again, it's just vacant land. Property taxes. That's important that they pay that. And then insurance as well. I think that's um, important. And that's one of the things that, when I say like this isn't really a loan, one of the things I think when I talk to some other people about this and they don't necessarily think right away, when I'm a lender and I have a lien on property, I have no real liability for for something that would happen on that property, right? Like if somebody were on that property that shouldn't be, they get hurt, they try to sue the property owner. They're not going to sue the lender in that case, right? And that lien actually, like, we have priority over somebody else coming and suing that owner and having, creating lien. Well, in this instance where we are actually the Dow ends up buying the property, we don't enjoy that same benefit of just being a lien holder. um so in my mind, that it makes this, I'd much rather this be a loan, right? I'd much rather make a private loan to this person than to have this be the case, right? Have it be that I'm the owner, and I'm renting it to them, because we're not protected in that same way, right? Um, Now, how it's maybe not a huge risk, but it is like we're trying to recreate the wheel here. Like, okay, this is kind of like a loan, but it's not a loan. But I just don't understand why we're doing that, right? Like, uh, if we're gonna make a loan, let's create a DAO that makes a loan, right? And have a note and mortgage be the asset that we own. Like, I'm not sure. I don't know. Maybe there's some issue with us doing that versus this. But I think it gives us a little bit. It puts us in a different position. The other thing, and I talked about this a lot in one other video about these, is we have this addendum to the operating agreement. Like, if they don't pay the rent, like, what do we actually get to do? Well, okay, we have the ability to claw back their collateral if they don't do it, and then we can vote to sell it and whatnot. But I think that, and I'm not going to go into it deeply here again, but I think that we don't really know. Yes, they have the mechanism in place that they can do that, but we don't really know how this is going to play out, if it ever were challenged legally, right? Because there are a lot of different structures throughout history that have been tried, that are like trying to avoid being a note and mortgage, but really that courts decided, what, that really was a loan that you made, and we're going to give them the same rights as if they were a borrower. That happens all the time with different creative structures people have come up with. And so I worry that in a case where we did just claw back those tokens from non-payment, and we tried to sell the property and whatnot, that if it were challenged legally, what the outcome would be, right? I mean, it's just untested. And you know me, I'm very risk averse, and I don't want to be the guinea pig unless I'm getting paid really well for taking that risk, right? And to me, the 10.3% return or whatever we calculated, 10.58% return, it's just not really getting me there yet. 10.3, somewhere in between there, those two is probably the real number. I just don't get very excited about that. But then I think really though, this is where it falls down the most. I probably should, is okay. So I started to talk about the collateral. We had the appraisal. It appraised for 100,000, but um, we're really valuing it at 105,000, and we're letting the co-owner, they get to sell up to 90% of this, right? So if they sell 90% of 105,000, they're getting 94,500 back. Now it's actually, the token prices it's even worse because there's higher token prices. But it's because there's also these other fees, there's other costs built into it. So just for simplicity, I just did the 105,000 times 90%. So if you look at this like from an LTV perspective, right? He could sell out if he wanted to 90% of the tokens, and and it's and if you remember earlier, I was talking about usually land loans, you're not getting a 90% LTV. Like very often you'll get 65%. Sometimes 50, 65, 70. You might get up to 90, but you certainly won't get to 94.5, which is what we have, if you sell 90%, because it's the 105%, right? So, I mean, this is a ridiculously high LTV that's being allowed if we're looking at this like a loan. Um, and then one other thing is when I'm a lender, and most lenders, they're going to look at your loan to cost as well. And so, okay, this was bought less than a year ago. So a lot of lenders are going to say, well, your cost was only 85,000. So there's no chance, so whatever percent we're giving you, it's going to be a percent of 85,000. Well, if we look at the loan to cost, it's 111%. This is one of the reasons why I'd like to know, did they spend money clearing the land? Did they, was their money spent to improve the value? And if that's the case, okay, maybe their cost is actually higher, and this loan to cost number isn't quite so ridiculous. But regardless, unless there's was a lot of money spent from either one of those perspectives, you have a very high LTV, and 10% is really just not that high for a land loan. Like it's not. I'm not getting paid for that extra. Um, for the really, and the reason LTV matters is that it's a measure of risk. So okay, let's think about this for a second. They spent 85,000 for it. They list it on Lofty. Uh, they sell 90% of the tokens, so now they've gotten all their money back, plus another $9,500. Um, okay, so then what happens when they don't pay? Well, we get to claw it back, right? And like this is our repercussion, right? We get to take it back and sell it for less than the 105 most likely. And it doesn't say, maybe, I mean, that seems to be what our recourse is, right? Is that we can do this. Now, maybe we could decide not to do that and then to hold them to the lease for the next 5 years. I don't know how that plays out, right? I don't know if that really works. But that's a way to maybe try to collect some additional capital from, um, from the co-owner who brought it on if they were. And now, and I want to make sure it's clear. I don't think that's this guy's plan. I don't think John is bringing this to the site saying, I'm just dumping it on here. I don't think that's the plan. But whenever we're looking at something, as an investment, we have to just assume the worst, right? Like especially if when I used to underwrite loans, because I worked in lending, that was my first role. No, it wasn't my first, but early on in my career, I spent a lot of time in lending. Um, and you have to be. there's no upside when you're lending, right? We're never going to do better than this. And I mean, that's not exactly true because they might pay it off early and we get a little bit of a bump. But in general, there's no upside in this deal. And the downside is, so that we have to spend most of our time thinking about, well, what's the downside, right? And so that's why we look at scenarios like this. And it's why lenders don't lend all the money that you have into a deal, right? Because they don't want to be left holding the bag. Um, and so, okay, so maybe in this scenario, we could say, okay, well, we took back the property, but then we try to hold them to this lease. If that were the case, I would just want a much nicer lease than this, right? I mean, there's just so little to it. Um, I think that they just use this as a way to, just to make it work in their system because they're really thinking, well, what we're going to do is take back the property. But if that's our only recourse, there's no way I would want to let them, you know, sell out 90% of this based on what we have going on here, right? And then I think it's even less protection. Like if this were, I think it's more likely someone would do this on this platform because this isn't a loan. Okay, we checked his credit, but there doesn't seem to be like how are we reporting this to this credit, right? Like are we reporting missed lease payments on the credit report? I mean, I don't know. Maybe we can do it, but there doesn't. This operation is not a foreclosure, so we don't have. He doesn't end up with a foreclosure on his record. Um, so I just feel like we're in a much less safe position than we would be with actual with an actual note and mortgage. One because like I talked about at first, it's an untested set up, and so if we had to, if there was legally challenged, we don't know what the outcome. Two, it doesn't necessarily ding his credit in the same way. It wouldn't put a foreclosure on the record. All the things that as a real estate developer, you worry a ton about that, right? Like my credit matters. I don't ever want to have a foreclosure because it makes it really hard to do deals in the future. Um, so I know they like to say this is kind of like making a loan, but it's very much not. And if I did just want to get in the loan business, like, ground floor is still an option, right? Like, even though I'm taking it, oh, by the way, please like and subscribe. In the description to this video, there's a link to our Discord channel. You can jump in there and have a conversation about this with me. I'd love to talk to you. But also, I have links to all the places where I'm currently invested in fractional real estate. Um, do your own due diligence on those platforms and on any properties on there. Just because I buy them doesn't mean that you should. Same thing with this, right? Just because I don't think this is a particularly good investment doesn't mean that it's not right for you. You want to just really dig into it yourself. I'm just trying to share my thoughts on it, how I'm comparing it to other options in the marketplace and whatnot. But so yeah, have recently talked about taking most of my money off of ground floor. Um, but if I were going to invest in this versus that, I think I would much prefer to have money in ground floor. I'm getting a slightly higher yield. I have a true, note and mortgage position. Um, you know, uh, of course, the default rate matters a lot, but it's a very similar thing, right? They're doing construction loans and fix and flip loans. So there's no reason to believe that I'd have a lower default rate with this property than I would there. Um, so one of the things I wanted to think about is like, okay, what if we wanted to make this work or to make this an attractive deal, right? And okay, and we don't, uh, but you still want to let them, excuse me, sell out of all of the, 90% of the equity. So it does look like we have this crazy high loan to value or loan to cost. Well, usually if I'm a lender, when I'm doing that, I say, well, what else do you have, right? Can we put a lien on something else? Could our DAO that owns this also get a lien on the project that he's putting the money into, right? Could we, I'm assuming there's a construction loan and maybe this would be a second lien. Uh, Maybe that's not allowed by his construction lender, but maybe we could get a lien or do mezzanine debt where we have an interest in his LLC, right? Where we have a lien against that, his LLC ownership versus the property itself. I mean, maybe not. Maybe we could take a second lien on his personal residence. That's the sort of stuff that I've done in the past. If somebody was looking for a higher LTV than what the property itself would normally justify. Um, but and so usually the reason you care about your LTV, okay, let's say they stop paying, we take the property back. You don't want to have, if you sell the property on the market and you assume your price is good, you still have all your transaction costs, right? And so it's got to be, you have to have some margin of error. And also, if they stop paying on it, it's probably because the market's not doing well and maybe your land value is even less, right? So that's why land, usually you'll have a bigger margin of safety. Um, I think it could work, right? Like there's from everything I've seen about this person, I don't have any reason to believe that he's bringing it on here default. I don't have, or that his other project isn't doing well or anything like that. It's really common when you have a lot of projects going on that you do need to pull money out of from somewhere. I just think that from my perspective, as someone who's done a lot of land loans, who's worked as an employee in places who's done a lot of construction lending, uh, that this is, it seems like a ridiculously high risk the way it's set up. And I don't really, and it's not a great yield, right? Like this is not a safer deal than uh, at least with the information we have, right? The people that I've talked to that buy these are like, oh, well, yeah, I know I'm going to get paid off in 3 years, and I'm going to get this yield until then. Well, you don't really know that because we weren't given any info about this person's net worth, about their income, about their ability to actually pay this off. If they can't, we're stuck with a lot that we have a hard time evicting a tenant and doing a turnover as a DAO, right? If you've been in any of the DAOs that have any sort of problems, we have a hard time dealing with a lot of those problems with votes and other DAO members. Could you imagine being in a situation where we think, oh, we're going to do something with this vacant land? Like, no, the only option we're going to have is to sell it. And then if that's what we're doing, we it's worth we're losing money on that sale, right? And so there doesn't seem to be um, for me to want to have a lower yield than a lot of the other properties on the platform, and definitely it's worse than most of the deals I'm buying on ground floor. Most of the deals I'm buying on Mogul have a better yield and have significantly more upside. Um, so if I'm comparing it to that, if it's not going to have a better yield, I want it to have less risk, right? And so that's why I'm saying like maybe you could figure out some structure. Maybe you say, okay, they're required to hold 40%, right? They're not allowed to sell 90% of the equity. That make me feel, I mean, that alone turns this into a significantly safer situation where you don't have to really worry about, um, you have to worry a lot less because well, let's see, is that true? I mean, if we end up selling it at a discount, so I mean, a lot of the stuff works differently because the co-ownership versus a lien, right? It is actually if this ended up being worth less, it would help us a little bit, but it's not actually the same as saying that that's a low, that it's not the same as if I had a 60% LTV loan because we don't get the preferred position in this instance, right? Like his equity, if we had to sell it at a loss in the future, his equity counts just like ours does. I guess though maybe if he had defaulted and we got to claw back some of it, maybe not. And maybe that's what they're trying to do there. I don't know. I mean, and this is sort of my problem with this in general is we just don't have, so we get to take back the remaining equity or 60% of the remaining equity. So does that really help us that much? I mean, especially if 60% is just another 6%, because he sold 90. Yeah, I mean, I, I have a hard time wrapping my head around how this is a deal that is interesting to people because of those issues, right? Like, because if we were making a land loan to him and it was a reasonable loan to value, 60%, 65%, and we're getting a 10% interest rate, yeah, I mean, it's a deal that would make a lot of sense to me. It's still not, for me, not me personally. I mean, I'm normally, the private mortgages that I've made, I've had significantly better returns than that. But in general, it's a deal that in the marketplace for loans, I think makes some sense if you did that. But in a scenario where we don't really know what protection we have, it's not. Uh, I think it's arguably less in that we have more liability and less, or at least more unclear protection, right? As far as what happens in the case of default. Um, and yeah, and it's really high LTV and similar yield that we're getting on loans elsewhere, but in fact, actually a little bit less. Um, so I don't know if you're interested in this deal, if you're buying this one, I'd like to know what your thought process is, why you're buying into it. Uh, if there's, as always, if there's something I'm missing, I'd love to hear about it. Because basically all of the deals that look like this that have come out on the platform, I just haven't wanted to buy. Like they just, and I don't know. They've definitely been popular as a product to bring to the platform, and I've talked to a lot of people in the Discord that like them, but I haven't heard a good explanation as to how you're thinking about the risk level of this versus a mortgage with a similar interest rate, especially when they have the ability to have such a high LTV and even significantly higher LTC. um, I think that's it. I talked about this for a long time. Sorry, I know I probably rambled and jumped around even more than usual. It's been a very long day, and so I'm going to be done now. Until next time. Oh, please tickle the like button. And now for real, until next time, I'm going to keep making mistakes so that you don't have to.